All right, Dr. Angraj, we'll come back to you in just a moment. But Sajid, if I could bring it to you, and I just want to put that question forward to you. Assuming that Dr. Rangarajan couldn't hear me clearly from the RBI, the fact that the RBI has reduced the growth outlook, raised the inflation outlook, is it high time we agree or sort of accepted that we are in a stagflationary phase?
George, I think there are two implications from that. One is that is consistent with a supply shock. And I think to the extent that we have a deficient and uneven monsoon, it's not really surprising that we should see both things being true, which is growth were to moderate because production would fall. At the same time, pressures on food inflation would cause headline inflation to rise. But I think there's a larger point here that we need to realize and admit, which is the fact that inflation can be at such elevated levels. CPI is running at above 10%. Core CPI has been running close to 10% for the last 6 months. At a time when growth has been tracking below 6%, the only way you can square that circle is to accept, unfortunately, that India's potential rate of growth has fallen quite sharply. Because when the potential falls, even though actual demand were to fall, you're not running very large negative output gaps, so to speak, to cause inflationary pressures to reduce. So that's what I can sort of glean from what's happened over the last 3 quarters, that our potential has fallen because our investment ratio has come down quite sharply, and that really has to be the key priority for policymakers.
Right. So, Rajiv, I'm just going to come to you and pick up on the point that Sajid made, the fact that, we are running just below our potential output, and the fact that, when growth does come back, and given the fact that capacity constraints are fairly, to the extent that we face these capacity constraints, would you say that when growth comes back, inflation is once again going to re-emerge as a big problem for us?
I completely agree with the point that Sajid made. I think despite the fact that growth has come off so sharply, clearly inflation has remained quite sticky. I don't think the issue is about when growth comes back. I think the issue really is about when we are able to contain inflation in whatever shape and form, core inflation, headline inflation, CPI inflation, whatever you want to call it. I think that needs to be priority as we go forward. I think until we are able to contain that, to expect growth to go up in any meaningful fashion, I think is being naive. And I think I certainly like the commitment to containing inflation and inflationary expectations that the RBI has demonstrated over the last 3 to 6 months. So I think clearly it is well articulated. The fact that the fiscal deficit is an issue, the quality of the fiscal deficit is an issue. We need to move money away from subsidies into investment spend, and like I said, that will help us manage the supply side issues as we go forward, and therefore inflation.
Sure, but Rajiv, this is something that we've talked of, God knows for how long. I think every policy we meet and we discuss this whole thing about the quality of the fiscal deficit needing to improve, the fact that subsidies need to be moved away into building more productive assets. We've talked about this endlessly. There's no action from the government. At the same time, you've got the RBI saying that they can't do much more than what they've already done in the absence of action from the center. Is it safe to assume now that you may not possibly see any monetary policy action from the RBI, maybe for the remainder of the year?
I think we would probably see RBI action only if 2 or 3 things happen. One, there is clear action from the RBI from the government to contain the fisc. 2, if there is a very, very sharp slowdown in terms of growth, or 3, if there is a external shock that hits the Indian economy. I think if one of these 3 things happen, I think it is fair to expect a rate cut as we go forward.
All right, Mr. Gupta, if I could bring it to you now. Your boss, Mr. Chaudhary, has been a champion for a CRR cut. It hasn't come. Would you be disappointed?
No, it will be life as usual. If the CRR cut had come, that would be a bonus. So as I have been saying, it is a wish list for banks to have a CRR cut. But clearly, liquidity has been provided. Credit offtake is muted. I don't think it really... it's not really a disappointment. It's just that we'll hope for some relief next time round.
All right, Mr. Gupta, we'll come back.
Okay, let's just get in a comment from Mr. Chako as well. Just wanted to, take on the point that the governor did make, that lowering rates right now will not necessarily stimulate growth. Do you think that we can take this statement to interpret that come the policy in September as well as October, that we perhaps might see a non-event once again?
Well, actually, looking at hearing what the governor said, we are lucky that there's not been a rate hike. Because if you look at the factors, he talked about the food inflation, he talked about input costs going up, or partly because of the exchange rate, uncertainty about crude prices. He didn't talk about wages, but I think Sajid talked about the wages hike. Then we have this big elephant of the state electricity boards and their tariff revisions, which will also add to inflation. Then commodities, we haven't benefited from the lower commodity prices a few weeks ago because of the exchange rates, and now it's going up a wee bit. Diesel price potential hikes. So we're actually looking at a situation where we are talking about rate cuts. But if this continues and if there's no action from the government, you could see a rate hike perhaps in the next quarter, not just a standstill kind of situation. I don't know what the economists say, but this is what I would say, that if it stays where it is, it's good. But perhaps with the possibly a new finance minister coming in, or the Prime Minister continuing with it, whatever, there should be some action from the government now. So it's very difficult to forecast what's going to happen in the next policy.
It certainly is. Let's also bring on board Shanti Ekambaram, President Wholesale Banking at Kotak Mahindra Bank, who now joins in live. Shanti, were you surprised by no rate action, or were you on the camp of the unanimous people that believed that this time around it was likely to be a non-event?
No, I was a part of the camp which believed that there was no interest rate cut going to happen, so it was not a surprise.
Were you perhaps hoping that this time around there would have been a little bit of tinkering with the CRR?
No, I think if you see the run-up, maybe the last 1.5 months, liquidity has been reasonably comfortable in the system, and hence I was not necessarily expecting a CRR cut. Moreover, I think RBI has used other tools that is available to it from time to time through OMOs to infuse liquidity into the system. So I guess there was not so much of an expectation on liquidity as much on the rates. And I think if you look from a rate perspective, from the last policy to now, very little has changed from RBI's perspective in terms of any moves on the fiscal side. If any, the view on inflation and the outlook on inflation has actually become worse since the last policy. For all the reasons that the governor has outlined in his policy, I think inflation is looking much stickier than what it did 3 months ago. And that's the reason why there is no change in rate, and they've actually increased their view, or rather their outlook on inflation from now to March as against the contrary. So I think given the sticky inflation situation, there was no expectation of a rate hike. Given the lack of any action on the fiscal side, either in terms of a diesel price hike, further passing off on some of the costs of coal, electricity, etc., there was not much expectation of any interest rate hike, at least on my part.
All right, Mr. Gupta, if I could bring it back to you, the cut in the SLR from 24% to 23%, would you say it is, it's in theory it sounds great, but in reality it's not going to mean much for banks?
No, I think it's a cushion. It's an insurance. Should credit offtake pick up, we won't have a liquidity issue. We have that amount of buffer. But as of now, obviously, credit offtake has been slow. And it does not seem to be picking up in a hurry. So I think the SLR cut will be used only in course of time.
Sure. So in course of time, so far in the first quarter, we've had credit growth at about 17.7%, slightly under 18%. Do you believe that this growth rate will hold up, or do you believe that credit growth is going to come under pressure somewhere?
Numbers can be very misleading. So it's like a patient who's ill, and you're monitoring the blood pressure and the pulse rate, and specific parameters can change from time to time. Overall, we are in a stressful situation. If you look at the credit offtake, it's been lower year on year, but it's been higher year to date. So you don't know what to read into the numbers. It's 2.4% year to date for this fiscal year, including food, 2% without food, as against the corresponding 1.8 and 1.6 last year. So I don't think I'll read too much into the short-term numbers. You know, we should not be really trying to produce a trend out of 1 month or 3 month figures. But on the ground, we know that credit offtake is muted. The pipeline for projects is, close to dry. And there is a lead time for all this to come back. So I don't expect the credit offtake to really take off in a great way over the short term.
Right, and Sajid, bringing it back to you, would it be right, the fact that we've seen private investment, a complete breakdown on that front, what do you believe we need to do to get it back up?
I think it's very commendable that the RBI now for several meetings has stuck to the theme that it's not interest rates. Real interest rates over the last year, George, were exactly the same level that they were in the 3 years before 2008. And those were the 3 years, if you remember, that both investment and industry was booming. So interest rates really, in my view, are a very minor factor that's affected investment. For me, the more damning statistic is what the CMIE has, which is if you look at the number of projects on the ground that have either been stalled or abandoned over the last year, that's 3 and 4 times higher than what had happened in previous years. And the issues have got very little to do with interest rates. The bulk of the issues are land acquisition, environmental clearances, policy uncertainty, regulatory uncertainty, provision of coal in the case of the power sector. So I think those are the set of issues which really are in the government's domain that needs to be pushed through. I think if we can push through with those issues and the government makes a credible sign of fiscal intent to take away any lingering concerns that some rating agency a few months from now might downgrade us, I think those become the ingredients for investor sentiment picking up. So I think the focus really has to be on those sets of issues. In the question of reforms, people talk about FDI in certain sectors. Those are nice announcement effects. It'll boost sentiment for a few weeks. They typically have productivity impacts years later. In the current environment, to boost investment and therefore India's potential rate of growth, it's really action on the ground to remove all of these implementation bottlenecks. I think that's the key driver for any investment pickup in the coming quarters.
Right, Shanti, if I could bring it to you, I did hear you say that you were in the camp that expected today to be a non-event. But apart from the rates front, what would you widely like to see the RBI do?
I think, frankly, RBI has said and done what it should do. Actually, I'm complimenting the central bank in sort of announcing what it said and laying out the concern. If you ask me, for really stimulating growth, for action on the ground, all roads, I think, lead to the center, which is the government. I think we have to ensure that there is movement at the ground level. Actually, somebody just talked about the fact that projects are stalled, clearances are not happening. For one reason or the other, execution of investments put out by so many people in the last 3 years have either not come to fruition or have come up but are not operational because of lack of linkages, whether it be gas or coal or any other matter. Right? So I think we are living in an extremely volatile global environment. If we want India to come back on track, we have to provide positive sentiments to boost growth. Ideally, if you ask me, at a time like this, the government should be spending on infrastructure. Government should be laying out investments that will boost the economy. But unfortunately, the government has very little headroom. Given the fiscal situation and the fiscal slippages that have happened, the government has had very little headroom to be able to invest. In absence of that, they should really be laying the ground out for investments, whether it is local or global, to say, here we are, here we will help you, and this is how we need to do something. So I think the central bank can only do so much, and I think the central bank has done what it has. It said clearly it's going to work, target inflation management. It will provide the necessary liquidity for the growth, as well as will support sustainable medium-term growth. So I think my expectation from the central bank has been exactly what it has delivered. I think all roads lead to the center.
Sure. So, Rajiv, coming to you and picking up on the points that Sajid and Shanti both made, would you say that, rather than focus on the big bang reforms like FDI and multi-brand retail or insurance or aviation, if the center just focused on some of the, the unsexy things, so to speak, like, last mile connectivity on a number of projects that have been stalled across the country, that itself has the potential of raising or boosting sentiment hugely and then getting everything else back in order?
Absolutely. I think it's not about reform, it's about perform. I think there are so many projects which are stalled, and I think the number could be anything in the vicinity between 200 to 300,000 crores. That itself will add percent and a half to growth in the years to come. Two is it'll improve sentiment, and I don't think the issue really is about liquidity or money. I think in a global environment where yields are at 0%, I think all that money is looking for a profitable home. And I think if we are able to sort of demonstrate to the world at large that we are getting our act together, we're getting the fist together, we're getting policy in control, and we are now really looking for pro growth, I think attracting money from a global perspective shouldn't be too much of an issue. So I completely agree with both Sajid and Shanti that it is really in the hands of the government to push forward in terms of many of these very large projects, some of them to take off and some of them to fix. There is about 25,000 megawatts of power plants on the ground ready to produce, but linkages haven't really come through for various reasons. So simple issues like that, if they can be resolved, I think it improves the supply side issues on the one side, improves sentiment, and will certainly improve liquidity and therefore the rupee as well.
All right, Sajid, a quick last word from you on the subject of inflation. Now, while it is remaining at elevated levels, how worried would you be about the likelihood of QE coming out of OECD markets and, taking up commodity prices and the impact of inflation on that?
I think that's a very legitimate concern for India. Our own sense is that the likelihood of the US Fed, for example, doing more asset purchases in the month of September is growing. We've already seen that the ECB has signaled in recent days that it will do what it takes to protect the European Union. The Bank of England has done more. So China is cutting rates. So I think you could be in a situation where you have coordinated central bank easing. That's possible in those economies because inflation rates are 2 or 3%. But what that does, therefore, is to push up global commodity prices even further. They're up 10% over the last 6 weeks. Push up crude prices even further. Now, if you add to that the concerns we have with the deficient monsoon, let's be clear. I mean, it's not as naive as it sounds. The large food stocks of grains, if the government manages those judiciously, you could contain grain inflation. The concern is more about pulses and oilseeds, for example. But if you do have a deficient monsoon, food prices will go up. We now have a very direct linkage to wages. NREGA wages are formally indexed to inflation. We know NREGA wages have become the floor for rural wages. So all of the risks in a way to inflation for me are to the upside going forward, both through the monsoon and through what happens externally, which is why I think we will be in a situation for the next few quarters where inflation could be very sticky in above 7% range or so, and growth could still be anemic, which is why you now have to have the correct division of labor, which is the central bank focuses on making sure that inflation expectations don't get unhinged, we don't go back towards the 9 and 10% levels we saw last year, and the government needs to take a control on doing the investment, focusing on the investment issues to try and give growth a boost.
All right, Sajid, thanks very much for having joined us on the show with your perspective on the RBI policy action or the lack of it. Abraham, if I could come to you, again, just focusing on the credit picture, how are you seeing credit growth pan out for the remainder of the year? Would you say that the 17% target that the RBI has chosen to stay with is not going to be that easy to meet?
No, I think if the projects take off, it should not be a problem at all. That's what's holding it back, because the big ones are the big infra projects which are slow at the moment. If that happens, I don't see an issue with that at all. However, in terms of exports, since the overall foreign markets are subdued, even though we have a favorable exchange rate for the exporter, that's not going to take a really big offtake of credit, I feel, because a lot of the input costs are also in the raw material inputs are also there for these exports. So it has to be infra which kicks this. And of course, it depends on the initiatives taken by the government. And I think, as most people are saying, as on the panel today is saying, it's really infra, which is going to be the first big step forward. And secondly, we have to also look at the sentiment. It's a question of marketing India. At the moment, most of the BRIC countries which we say we compete with are at much lower growth rates than India. So it is an opportunistic time to really attract investment to India. And I remember in the late 80s, there was a gift scheme that the government had introduced where money could come in to you from anybody and just declare it as a relative has sent it. And that flushed out a lot of money out of the country and brought it back. And that could be perhaps something that we could do now with the exchange rates being what they are. And because I think we have mopped up the bulk of the regular NRI deposits over the last few months.
Right, and Mr. Gupta, just bringing it to you, Abraham did touch upon the point about the focus needing to be infrastructure, and that's what's possibly going to drive credit offtake. But based on your engagement with clients and your large corporate relationships, what's the sense you get on that front?
No, my sense is that anxiety is actually keeping investment decisions away. So there is a segment of clients that is sitting on cash, but they would much rather wait and watch before they put their money on the table. I think therefore really sentiment is something that needs to be shored up. Fortunately that can be done relatively easily, but I think fiscal prudence, moving from expense offsetting to value creating subsidies, that's the sort of stuff that we need to move to, and immediately demand will come back. You know, the political economy really has to be managed for that, because diesel directly for the marginal farmer really does not affect him as much as a food inflation, but it's harder to do. So we need to find what can be done and quickly go ahead with that, improve market sentiment. As Mr. Chako said, there's a lot of capital waiting to flow in if the climate is right.
All right, Mr. Gupta, thanks very much. Appreciate you joining us on the show with your view of the credit policy. All right, we've got Mr. Sushil K. Maru, who's the Chief Financial Officer at Jindal Steel and Power, joining us. Mr. Maru, you know, industry constantly complains that interest rates or high interest rates are the big culprit for weak corporate performance. Would you still go with that stance, or is it time you acknowledge that, you know, it's more policy action at the center that's actually creating most of the problems for your sector? All right, we've got Mr. J.C. Sharma of Shobha Developers also joining us on the show. Mr. Sharma, your assessment of the credit policy.
See, we also believe that in India, when the demand scenario is still remaining so robust, it is for the Reserve Bank of India to do a proper assessment whether they have to give priority to contain the inflation or to bring back that investment cycle and bring back the GDP growth rate, where we are capable of doing more than 7% year-on-year basis, at least to begin with. And the interest rate definitely is a big dampener, and we all do believe that the Reserve Bank of India must look at somehow to ensure that the growth comes back, and they have to ease on the interest rates by reducing it, the repo rate and the reverse repo rate.
All right, so but that's not happening anytime soon. But Mr. Rajiv, just bringing it to you, you know, the fact that the RBI has said that they can't do very much more from here on, that the center needs to actually get moving on a number of policy issues. Is it time, you know, we started actually expecting fiscal policy every 3 months from the center, where the center gives us an update on things they've done in order to get growth back on track, and it's time we stopped focusing on the credit policy?
I remember that one of the finance ministers had indicated that you know, they would actually, you know, put out in the parliament a performance report card on the various large policy reforms. Yes, I think we'll certainly look at that, and I think it would certainly put pressure on the government if something like this is monitored. I mean, all of us do it in the corporate world, isn't it? I think it certainly makes sense for the government to do it as well.
All right, we've got Sushil Maru, who is Chief Financial Officer at Jindal Steel and Power, joining us on the show. Mr. Maru, we had Mr. Sharma of Shobha Developers just a short while back saying that you still need interest rates to come down if demand must improve. But here we have demand which is creating the whole problem of inflation. So again, just focusing on your sector, would you continue with the stance as many of your colleagues in corporate India have been sticking with, that interest rates have been the big culprit for your performance having deteriorated?
In fact, the interest rate is playing a major role because the margins has come down. Besides, not many companies are in a position to access fund, and that is very seriously affecting their ability to execute new projects, take up new projects, and do buy things and work on the projects. So certainly that's also affecting the demand of the steel in the market, and that's really the scene.
So it is affecting demand, but between the lack of policy action at the center and high interest rates, which do you believe is the bigger concern for you?
See, I feel that interest rate is a major factor in any case, and availability of fund is also very, very important. But since presently we are in a slowdown scenario, so higher interest rate makes a major difference because it squeezes the margin, and the companies really don't know whether they'll be making profit in their projects or not, or any new venture they take up, what is going to happen. Besides, access to capital also is very low, and the liquidity is also affecting many major decisions.
All right, Shanti, if I could bring it back to you again, going back to the tone of today's policy document put out by the RBI, would you scale down your expectations in terms of the remainder of rate cuts that you are expecting for the rest of the financial year?
I think unless you see significant sustainable change to the trajectory of inflation, unless you see some fiscal policy action on behalf of the center, I don't think you're going to get any rate reduction unless there are any global shocks to the system. So if there are any global shocks to the system and there needs to be liquidity pumped in, rates have to, that may be a different situation. But if it's business as usual and normally, I think we have to see sustainable trajectory of reduction in inflation. It is looking quite to the contrary now. So as it stands today, it looks difficult to me as to why the central bank would reduce interest rates. But if there are a series of steps that are taken, say in the next 1 to 2 months time frame on the fiscal side, and which sort of eases the situation a bit and perhaps provides room for inflation to come down, you could see some action. But for now, it seems like inflation rules supreme, and hence no rate cuts as yet.
Right, Mr. Sharma, wanted to come to you, and given that we have spoken about that lingering problem of high interest rates as well as lack of policy action this time around, what would you say the overall situation on ground has been, and how has the demand scenario also shaped up for you?
See, we have always maintained and believed that in India, as such, demand is not an issue. How do we maintain the momentum is the challenge. And I think we are trying to link it, the inflation with the demand, in a manner as if there is a direct correlationship. The increase in the food prices or the current account deficit, we are trying to contain through keeping the interest rates higher than the global average by maybe 400 to 500 basis points, which is not sustainable. In our view, the role of the Reserve Bank of India, of course, while it is calibrating the inflation, should be to ensure that the borrowers who bring investments and who try to ensure that they keep that demand side thing always fed properly through increase in supplies, they should be permitted to function where their interest cost and the liquidity remains comfortable. And in a given situation, the increase in the interest rates or keeping the interest rates higher is not, in our view, the right way forward. And we do believe that the Reserve Bank of India and the government will create conditions where in times to come the interest rates will start coming down. As far as the demand aspect is concerned, we do believe that we have got the good quality customers. The numbers are definitely better, and we do not find any regions that there should be any slackening of demand in our industry.
All right, we've got Shobit Mehrotra of HDFC Mutual Fund also joining us on the show on the phone line. Now, Shobit, as far as bond prices go, what should we expect? Should we expect that they will remain range bound for a while at least? Now, to the extent that the RBI's, the language in today's document seems to suggest that you aren't going to see rate cuts anytime in the near future, possibly.
I think initial reaction of the bond market has been of a sell-off by some 20-30 paise. And this has been more because of a surprise SLR cut, which nobody was expecting. And going forward, a lot would depend on the credit pickup. We know that the system is already excess SLR, and still banks were continuing to buy government securities. But if credit picks up in the second half, in the busy season, and then the banks may not need to, buy GSEC, which could have some impact on bond prices. But for now, I would say, yes, bond prices would remain in a narrow range, having corrected some. Maybe they will, once the system gets adjusted to the new policy which has come out, I think bond prices will recover a little.
All right, Rajiv, just coming back to you for one. Right, Shobit, thanks very much for joining us on the phone line. Rajiv, coming back to you for a quick last word. What's your expectation in terms of what the RBI will do for the remainder of the year? Though it has clearly indicated that nothing's going to come from it in the absence of fiscal action, do you still expect some sort of a rate cut to come through before the end of the year?
I think let's take it one policy at a time. It looks unlikely that that inflation will come off, enough for the RBI to cut by the next policy. But I think there is a fairly large base effect, etc. So I think we don't expect a rate cut in the next policy, but I think we do expect in the vicinity of 25 to 50 basis points by 31st March 2013.
All right. We'd like to thank all of our guests for joining in on the show. Shanti, Mr. Sharma, Rajiv Anand, as well as Mr. Chako and Mr. Sharma and Mr. Maru. Thanks very much for joining in on this discussion of RBI's credit policy. As you know, this time around they have left the repo as well as the CRR rate unchanged, cut the SLR and lowered their GDP growth projection while hiring the inflation projection to 7%. But with that, from George and me, thanks so much for watching.